The transition of quantum computing from theoretical research to commercial infrastructure represents a structural shift in the global compute layer. This shift is currently accelerated by significant geopolitical catalysts, specifically the U.S. Department of Commerce injecting $2 billion via CHIPS Act capital into quantum hardware. For the institutional investor, the focus remains on computational supremacy, the capacity to execute molecular simulations, optimize global supply chains, and address cryptographic frameworks beyond the reach of classical binary systems. The current market environment is characterized by the construction of a foundational compute layer that will likely dictate technical dominance for several decades. Navigating this sector requires a rigorous elimination protocol to bypass speculative entities that lack viable pathways to fault-tolerant systems. To qualify as a structural winner, an asset must demonstrate a tangible commercial backlog, a durable architectural moat, and sufficient balance sheet gravity to endure a capital-intensive development cycle. This excludes high-velocity retail hype and prioritizes entities controlling essential commercial choke points. IonQ represents the primary commercialization play within the trapped ion architecture. Unlike superconducting systems that require energy-intensive, ultra-cryogenic environments, IonQ utilizes lasers to manipulate individual atoms. This approach allows systems to operate near room temperature while maintaining high error correction fidelity. Strategically, IonQ functions as an omni-cloud provider, integrating its hardware directly into AWS, Google Cloud, and Microsoft Azure. This creates a distribution flywheel that avoids the friction of legacy infrastructure lock-in. From a capital flow perspective, IonQ is transitioning from theoretical milestones to contracted revenue. At the conclusion of the first quarter of 2026, the company reported $470 million in remaining performance obligations, reflecting a 554% year-over-year increase in its backlog. While traditional price-to-earnings ratios remain inapplicable at this stage, this contracted revenue provides a necessary financial anchor. However, the investment carries a specific structural risk, the scaling ceiling. As trapped ion systems grow, the complexity of entangling thousands of ions in a stable trap increases exponentially. Should competing modalities such as photonic or superconducting approaches achieve mass manufacturability at a lower marginal cost, IonQ's precision-based advantage may face rapid commoditization. This asset serves as the high-beta speculative engine of a quantum-focused portfolio, offering asymmetric upside contingent on its architecture becoming the global standard. IBM functions as the defensive anchor within the quantum landscape, leveraging its position as a monolithic enterprise incumbent. Its competitive moat is dual-faceted, consisting of advanced superconducting hardware and a dominant software ecosystem. IBM's Qiskit has emerged as the de facto programming language for quantum developers globally, providing a significant barrier to entry for competitors. By integrating quantum processors with legacy classical mainframes and a global consulting arm, IBM offers a seamless transition for Fortune 500 companies. This full-stack approach ensures that they are not merely providing a raw engine, but the entire operational framework required for enterprise adoption. The financial profile of IBM provides substantial downside protection. The company self-finances its quantum research and development through the consistent free cash flow generated by its legacy software and consulting divisions. This allows for aggressive innovation without the equity dilution common among pure-play quantum firms. IBM's unit economics are rooted in a high-margin hybrid cloud model, enabling the company to absorb massive capital expenditures while maintaining a dividend yield exceeding 2%. Essentially, the company is utilizing classical revenue streams to subsidize and secure its future in the quantum era. However, the bear case for IBM centers on institutional inertia and the potential for stranded assets. The superconducting architecture favored by IBM requires massive dilution refrigerators, a hardware approach that is both bulky and energy-intensive. There is a systemic risk that if room temperature architectures, such as trapped ion or diamond defect systems, become the industry standard, IBM's heavy investment in cryogenic infrastructure could become obsolete. Despite this, IBM remains the core anchor holding for investors seeking immediate cash flow and deep institutional integration. It represents a bet on the mapped road network of quantum computing, where the software and consulting layers provide a safety net even if the underlying hardware modality shifts. The logic here is process-oriented. Control the developer environment via Qiskit and the enterprise relationship via consulting, thereby securing a toll on the transition regardless of the final hardware configuration. Teradyne represents the picks and shovels infrastructure play, targeting the automated test equipment chokepoint. In any technological shift, the entities providing the necessary testing and validation tools often capture the most stable, risk-adjusted returns. Teradyne's relevance is modality agnostic. Whether the dominant quantum architecture is trapped ion, superconducting, or silicon photonic, the underlying components must undergo rigorous testing for microscopic defects. Teradyne's silicon photonics test solutions, such as the Poton 100, act as an unavoidable toll booth for all advanced compute hardware moving toward commercial viability. Financially, Teradyne operates a high-margin engine that benefits from the broader expansion of artificial intelligence and high-bandwidth memory infrastructure. This provides a recurring free cash flow that funds quantum-adjacent R&D without the high-stakes gamble of predicting a winning quantum modality. Consequently, Teradyne achieves a return on invested capital that pure-play labs currently cannot match. The primary risk for Teradyne is its hypersensitivity to semiconductor capital expenditure cycles. Revenue can fluctuate based on global foundry demand or geopolitical export controls, which could impact the company before the quantum market reaches full maturity. When constructing a portfolio for the next compute cycle, these three assets form a barbell strategy. Teradyne serves as the low-volatility foundation, capturing immediate infrastructure spend across the hardware sector. IBM acts as the defensive enterprise anchor, utilizing its legacy cash flows and distribution network to stabilize the allocation. IonQ provides the hyper-growth spearhead, carrying the most significant technical risk but offering the highest potential for exponential gains should its trapped ion architecture prevail. The comparative verdict for a serious investor is a focus on structural monopolies. IBM provides the distribution, Teradyne provides the essential infrastructure, and IonQ provides the pure-play exposure. This tripartite allocation strategy balances the need for immediate financial stability with the necessity of owning the foundational compute layers of the coming century. The investor must accept short-term hardware volatility in exchange for a position in the long-term oligopoly of quantum architecture. Success in this sector is not found in chasing hype, but in identifying the entities that control the choke points of the global computational supply chain.